If you think about the life cycle of digital businesses or businesses in general, you can start off with early stage. And early stage businesses, their responsibility, quite frankly, is to grow the market, educate the consumers, find product market fit, and develop positive unit economics. Going then into growth stage, those businesses have proven all that out, and their responsibility at that stage is to really sort of go from startup to scale up and grow into their fixed cost structure. And obviously getting to a later stage, more mature financial sustainability and EBITDA and cash flow growth. Now, I think with the historic and unprecedented low rate environment that we've seen in the last several years, what's happened is we've stretched that early stage mindset probably a little bit too long. And at the beginning of this segment, JP, you alluded to a notion of normalization. And I think some of the pain that we're going through right now, quite frankly, is a normalization of those stages. And we're going back to I guess, the way things should be. And I think the good news is, in my perspective, companies and entrepreneurs now realize that the best way to grow is not grow at all costs and stretch this early stage mentality across a scale, but quite frankly to transition as quickly as possible through early stage, growth stage, and towards more financial sustainability.
Now, it might be more of a normal, quote unquote, setting actually for a lot of companies that have to prove they're profitable. But from the funding standpoint, some are calling this a funding winter because of the high interest rate environment. And folks like Temasek are becoming a lot more selective in how they're parting their way with capital. But they did mention that the dry powder, the amount of capital that's been set aside, the ammunition, for lack of a better term, has been actually growing. What is it going to take for the Temaseks of the world, or the other investors, to actually start deploying those bullets the way they used to, perhaps in that low interest rate environment, especially as they think that the funding winter might be here to stay?
Great question. So, I think if you think about what's really been driving, investor sentiment and the investor landscape, there's several factors. I think number one, as you alluded to, the global macro, high interest rates, high inflation, geopolitical tensions, war, market volatility, all of which weigh pretty heavily on investor psyche. The second element, I think, as we alluded to, is that Southeast Asia digital economy is really in the midst of an unprecedented pivot towards profitability. So they've taken out excess subsidies and incentives. There's now a laser-like focus on high-quality revenue and monetization, which, quite frankly, is incredibly healthy. But in the near term, what that's also done is that's changed the shape of the financial outlook for a lot of those businesses. As a result, investors have taken a bit more of a wait-and-see approach as they try and figure out what this all looks like and how to then price some of these deals in the context of the current macro environment. I think the third element is there is a little bit of a valuation expectation mismatch. So I think companies and existing investors still remember what their businesses could have generated 18 to 24 months ago. Mm-hmm. And investors obviously that are looking to deploy today are subject to the realities of the high interest rate regime that we've alluded to, and certainly having to price in some of this market volatility.